Thank you, Alex. That's awesome. I will. I'll make sure to get you back later on for that. Thank you. Hi, everyone, and thank you very much. First off, of course, I'd love to thank Patrick and Alex Gentry for inviting me to speak today. It came as a great surprise, so it's my honor to be able to speak to all of you today. Of course, I do understand that the entire SaaSCon is actually focused on AI, and definitely I'm going to get to that in my own speech. But I thought it might be a good way to set the tone of the rest of this breakout session to show what the Philippine opportunity is. So I'm going to speak a little bit about the Philippine Venture Capital Report, which we released last week, actually. Did any of you all go to the Build Festival? Okay. Oh, wow. Okay. A bunch of you went to the Build Festival. Okay, as you all are probably familiar, it was pretty loud, so you didn't hear anything I said back then, thankfully. And I can repeat myself now. So what is really the macro state of the Philippine startup landscape? Where is the market headed? What sectors are thriving, and how do we really compare to our regional peers? These are the questions that Foxmont, along with the Boston Consulting Group, answer in our Philippine Venture Capital Report. And it's what I hope I'll be able to shed some light upon today. So I'm excited to share with you some key highlights from that report, a snapshot of where we've been, where we are now, and where we're going. So as you can see here, there's been a lot of progress made since 2018. Honestly, we use 2018 as kind of a starting point. It's because that's when Foxmont was founded and when we started investing. But we've made a lot of progress from 2018. 2021 and 2022 were banner years for deal activity. Those were the first 2 years in which we broke $1 billion, and consecutively at that. And you'll see a dip in 2023, and I think all countries saw that dip as we saw the start of a tech winter. However, it should be noted that the Philippines dip was actually quite modest compared to our regional peers. So I'm happy to say that last year, 2024, turned out to be a year in which our investments into the digital ecosystem rebounded to above $1 billion again, and actually hit the highest ever deal value recorded for the Philippines at $1.12 billion invested into the digital ecosystem. This is actually in contrast to many other countries and many other neighbors who experienced continued decline in fundraising from 2023 and 2024. I wanted to make clear that actually we only track primary investments. You'll read a lot about secondary and shares being bought for large companies, but we're actually tracking investments for growth. So no secondary transactions were actually recorded in this list. And you can see that on the graph to the right, your right, what we see here is the Philippines continues to take larger and larger pieces of the regional investment pie. Last year, we saw that 19% of all regional funding came into the Philippines, which now makes it the second largest destination for investments in the region. While 2023 saw an increase in smaller ticket deals that drove overall deal volume, 2024 had a larger share of growth stage investments, especially in the $20 million and up range. I can point to a few companies that are probably in this SaaSCon that benefited for these types of investments as well. Here's another interesting point. We've seen that most emerging markets will generally follow the same emerging industries to invest in. You'll see that in 2023, fintech, B2B, e-commerce, and often D2C as well. In 2024 in the Philippines, 2 new industries rose to the top. Clean tech, known as climate tech, and logistech. This to us at Foxmont represents the maturation of an ecosystem where different types of players are receiving a more diverse range of investors. Our new report, by the way, does interview a few of those investors and ask them why clean tech is interesting for the Philippines. So if you do have a chance to download the report, if you've seen the report, I'd ask you to look at a specific page, page 7, to see what they actually say. I'll make a side note here too. My own observance here is that I'm starting to see more AI-focused startups pitch Foxmont specifically. I can't say that there were too many in 2024, but surely over the last 12 weeks since January, I'm surely seeing a lot more these days. Of course, fintech and digital finance continues to be a big contributor to investments in the country. Fintech deals last year generally swayed larger. We saw companies like Bill Ease raise a considerable amount from TPG's Rise Fund, and even Gcash raising some primaries in preparation for this year's IPO, or hopefully this year's IPO. But why is fintech so hot? And I think it shows it right behind me. You can see how quickly digital payments have grown in the Philippines. In 2018, it was only 20% of the total value of payments and 10% of the total volume. But look what happened during the pandemic. Digital payments by value and by volume grew exponentially between 2020 and 2022. And by 2023, both of them represented over 50% of the way that we all transact money. For example, I don't know about any of you, but I actually don't carry any cash anymore, 0. So don't look for me outside. I don't have any money for you. In a very few short years, the Philippines will become largely a cashless society. I also wanted to point out this very interesting fact that we learned from Data Reportal. Of the internet users in the Philippines, 91.3% regularly use financial services as compared to 37.8% worldwide. I actually think this makes a lot of sense. If you think about the way that we all in the Philippines evolved online, we started by being the #1 social media user in the world. And literally that was it. We were just messaging and posting, and that was what we were known for. Until the pandemic, when we were all locked down. And then we all learned pretty quickly how to transact online as well. And that was really the second thing we learned how to do. And because it was the second thing, it became one of the core reasons for us to be online, besides social media, of course. Which actually leads me to social media. Very famously, the Philippines has always been known as one of the top Facebook consumers in the world. In 2015, the World Economic Forum even named the Philippines as the most active country on social media. But look how quickly other social media platforms caught fire. Today, we are now TikTok Shop's 5th largest market globally, with over $3 billion in GMV sold on the platform last year. And look at advertising on TikTok, by the way. If one were to advertise on TikTok Philippines, you could potentially reach 80% of the Philippine adult population versus the global average of under 30%, which actually, now that I say it, means that 80% of you all out there have TikTok? That's crazy. Anyway, I won't say. But that's, wow, amazing. As our ecosystem matures more and more, we start to receive questions about the IPO market in the Philippines. And the general answer I give is really twofold. One is that it takes one tech first mover to bring others in. And really, I believe that is Gcash, not to put more undue pressure on them. And two, that it requires regulatory changes to increase trading volumes, which are really increasingly being implemented based on my own conversations with the Philippine Stock Exchange, for example. Moreover, some of the effects of those regulatory changes are already showing in how public market traders have generally become younger, as you can see here with the 10-year differences. Additionally, we can see more trades happening online, thanks to the likes of Call Financial, G-Stocks, and of course, our personal favorite, Invesco. If you haven't downloaded it yet, please do. Finally, we are seeing an increased participation from lower income groups. These trends show us that an emerging retail investor market is growing in the Philippines. If we combine that with a blockbuster IPO that everyone can feel that they can participate in, like Gcash, then I actually really do think we have a fighting chance in spurring public market activity in this country. These shifts in market participation are more than just numbers. They reflect a broader economic transformation. As younger traders and lower income groups gain access to investment opportunities, it's clear that financial mobility is increasing. This ties directly into a key theme of our 2025 report, the growing middle class. One key theme of our report is the growing middle class. I think this is implied by our cover page of the report, which you saw earlier, that shows that our citizens are climbing an economic ladder. In fact, what you'll find in our report is that the Philippines middle class has actually grown by 13% since 2012, and the poor population has actually declined by 39%, according to the Philippine Statistics Authority and our own analysis. We've had a 20% rise in total population in 2012, and our middle class has actually grown from 42% of the population to 47.5% of the population. That's more people being able to afford more things now than ever before. We like to think of the growing middle class as also moving up in Maslow's hierarchy of needs. You can see here that in every stage of the hierarchy, there is growth in spending. Of course, the largest growth can be seen at the base level, which is physiological needs. But Filipinos are spending more at every level, showing that we, as Filipinos, are increasingly becoming more discerning and are spending more beyond the fundamentals. It's a huge opportunity. And just a note here, of course, Foxmont recognizes the growth of the middle class. And if you looked at our own portfolio, you'll see that we do address each level of Maslow's hierarchy. I think it's pretty well known that we like to invest in Filipino solutions to Filipino problems. But now that we know that there is a growing middle class, and data tells us that the average population savings ratio has jumped to 27% in 2023, what does this actually mean for specific verticals? We actually think that there's 4 sectors that's going to be heavily impacted. And these are the 4 that we have really believe that we'll put some effort into this year specifically. The first is health. With a growing focus on wellness, a demand for healthcare services, products, preventive care, and insurance is rising. And by the way, just as a side note here, Joanne Yao and I were speaking about this earlier, and in her own analysis, AI will have a very disruptive effect on healthcare. So it's excellent analysis, Joanne. Second is financing, and more specifically, MSME lending. As entrepreneurship gains traction, access to financing is crucial for small business growth, with over half of Filipinos aspiring to start their own ventures, according to a recent BCG report, which is good for us, actually all the investors at the table. The third is power. Higher living standards and increased appliance use will drive demand for reliable electricity, requiring improvements in power generation and distribution. And finally, it's agriculture. The push for wellness and premium food calls for stronger supply chains, higher quality production, and sustainable farming to meet growing demand. In recent years, we've seen a major shift in how Filipinos approach their health. More than ever, people are taking charge of their well-being, prioritizing prevention over cure. As you can see in the chart, more Filipinos are investing in wellness instead of waiting until they get sick. This transformation is largely driven by the growing middle class that is becoming more health conscious. With rising incomes and greater awareness, demand for not only preventive healthcare but also higher quality medical services has surged. But despite this positive shift, major challenges persist, leaving many Filipinos feeling vulnerable and financially unprepared for medical emergencies. These challenges include, first is talent retention. With better pay and benefits abroad, or even in other industries, many healthcare workers migrate, leaving a critical gap. Only 51.8% of registered nurses stay in full-time roles in the Philippines. 49% of our nurse population leaves. Gaps in infrastructure is the second one. Our hospital bed density is only 0.96 beds per 1,000 people, far below the World Health Organization's recommended 5 beds per 1,000 people, impacting care quality. We're not even guaranteed beds when we go into the hospital. Limited insurance. Filipinos pay 44.4% of healthcare costs out of pocket, compared to just 8.8% in Thailand, for example, making care unaffordable for many. This is where innovation and technology and hopefully AI come in. Startups are stepping up to bridge these gaps and transform the healthcare landscape. A couple of examples. Firstly, empowering healthcare workers with digital training. We're seeing that already at Foxmont with companies pitching us AI-driven training tools. So AI-driven training tools can assist healthcare professionals with decision-making, automate routine tasks, and reduce the time spent per patient, all while improving the quality of care. Secondly, building health tech platforms for smarter healthcare. Digital solutions like AI-powered diagnostics and telehealth services are revolutionizing access to care, making it faster, more efficient, and less burdensome on healthcare workers. Thirdly, offering micro health insurance for affordability. Microinsurance models provide flexible and affordable health insurance tailored to families and individuals, ensuring more Filipinos can seek preventive care and treatment without financial strain. And that's actually a direct reference to one of our portfolio companies within Foxmont called RuralNet. Startups are not just filling gaps in our healthcare system, but they are redefining how Filipinos access and afford healthcare. Sorry, just before I go on, are any of you guys Xenia users? Xenia? Yeah? Okay, we've got a few Xenia users. That is already AI-powered healthcare to your home. So I'll tell you a little bit about that later on. Impact of the growing middle class, SME lending, MSME lending. So next we have the micro, small, medium enterprise lending. MSMEs are crucial to our economy. They represent 99.6% of all businesses, and they employ 67% of our workforce and contribute 40% of our GDP. Yet, despite their critical role, they only receive 4.1% of total bank loans. Far below, there's an actual legal mandate of this, it's 10%. But of course, it's high risk. This graph highlights the stark reality of MSME funding gap. The real funding demand of the Philippine MSMEs stands at a staggering $221 billion. Yet formal credit supply is only $9 billion. Even if banks met their mandatory credit allocation of $22 billion, there would still be a $199 billion shortfall. This immense gap underscores the urgent need for expanded financial support to empower MSMEs. The challenge exists on both sides, by the way. Banks are reluctant to lend because they see MSME loans as high risk and costly to process, especially given the small loan sizes. For many banks, the returns just don't justify the effort. I mean, that just makes a lot of sense. But on the other hand, MSMEs struggle to meet formal banking requirements, often lacking the financial documentation, credit history, or structured business processes that banks expect. And I'm sure that we've all experienced that in this room. But the landscape is changing. Fintech startups are stepping in, reshaping MSME lending by making it more accessible, efficient, and scalable through technology-driven solutions. Taking a closer look at how, I've got 3 points here. One is innovative financing models. Fintech companies are rethinking MSME lending with working capital loans, revolving credit lines, and invoice-based financing. Even within our own portfolio, for example, we've invested in a company called Advance that not only does earned wage access, but does MSME lending in exactly these ways. These alternatives provide businesses with more flexible funding options, helping them maintain cash flow, sustain operations, and invest in growth without the traditional burden of large collateral requirements. Second is hybrid products with data-driven tools. By leveraging data-driven risk assessment tools, fintech companies can help banks evaluate MSMEs more accurately. These tools use alternative credit scoring, transaction history, and predictive analytics to assess creditworthiness beyond financial statements. And this is actually where you'll see a lot of AI kind of layered in. With better risk management, banks can lend with more confidence and expand financial access to more small businesses. And finally, empowering MSMEs for loan readiness. Many MSMEs struggle to qualify for loans due to poor financial tracking, limited credit history, or a lack of formal processes. Fintech startups are addressing this by providing digital accounting tools, credit building programs, and outsourced financial services, ensuring that MSMEs can meet banking requirements and improve their chances for securing funding. These are just a handful of solutions that are already reshaping MSME financing in the Philippines. By closing the funding gap, fintech startups aren't just supporting small businesses, they're actually really driving economic growth in this country. As mentioned earlier, the rise in discretionary spending paired with aspirations for higher living standards will drive greater demand for power. As the middle class grows and becomes more discerning, what were once considered nice-to-haves, like large fridges and air cons at night, they're just becoming necessities, further increasing household energy consumption. And that's just the consumer side of the demand. With our country continuing to grow at 5 to 6% per year, commercial and industrial energy needs will surge as well. We took a deep dive to identify where the opportunities lie, and the numbers speak for themselves. There's a projected shortfall of 12 to 39 terawatt hours by 2030. we're not going to have enough power to keep our air cons on at night. That translates to a massive $5.5 to $17 billion in necessary project investments. Fortunately, actually, the government is stepping up. In 2024 alone, it issued 4,000 certificates of compliance, which adds 100 terawatt hours. So we will be able to use our air cons at night to strengthen grid security and affordability. Major industry players are also driving the nation's electrification forward. AC Energy, Meralco, San Miguel, Aboitiz Power are all actively expanding their renewable energy capacities in the coming years. This is a pretty cool piece of news, which will make our next report. Foreign investors are increasingly participating as well. I don't know if anybody noticed, but the latest news is that there's a fund called Actis investing $600 million into Terra Philippines. And that was just announced 3 weeks ago. That represents the largest foreign direct investment in a single project for greenfield infrastructure in the Philippines. But there's also opportunities for VC investments, as you can see in the screen behind me. First is renewable energy generation, particularly solar and mini hydro. These aren't just alternatives anymore, they're fast becoming the most viable and scalable solutions, especially for off-grid communities that have long been underserved. We live in a nation with 7,000 islands. It makes sense to have off-grid servicing. Next, sustainable transportation. From EV infrastructure to battery tech and smart mobility, the shift to greener transport isn't just a trend, it's really a necessity. And finally, energy access and management. Smart grids, energy storage, and demand-side solutions are revolutionizing how we produce, distribute, and consume power, making it more reliable, efficient, and affordable. And again, we've invested in something that really addresses this needs. It's a company called SolX. If any of you are running, warehouses, buildings, please look them up. They'll help you save costs on your power by 30%. I'm not getting paid for that, but please use it. With these opportunities and increasing international investor interest in clean tech deals, like I said earlier, there's just never been a better time to be involved. The fourth and final vertical that we believe is ripe for disruption, given the demographic changes, is actually agri-tech. I think we all know that the Philippines has tons of natural resources, but did you know that the agri sector currently contributes about 10% of our GDP and employs 25%, 1/4 of our country's workforce? Despite those numbers, we're actually struggling in two ways. First is that as a nation, we cannot even meet our own food demand, where we have a trade deficit of over $11 billion. Second is that based on a survey done by Foxmont and by the Boston Consulting Group, 36% of our farmers are struggling, as you can see here. We decided to do our own deep dive and some primary research into what differentiates struggling farmers from stable farmers and strong farmers, what makes the good farmers good. And what we learned is very interesting, actually. The best performing farmers, the strong farmers, are generally younger. They're actually more likely to have transportation equipment to sell crops. They are more likely to have a smartphone. They are more likely to have internet access. Here's a striking insight. Only 34% of farmers we surveyed have reliable internet access. But among the top performing or strong farmers, that number jumps to 65%. Why does this matter? For one, internet access gives these farmers a direct line to end consumers, allowing them to bypass middlemen who often take a significant cut of their profits. It also opens the door to valuable resources, from best farming practices to e-commerce platforms where they can purchase farm inputs at lower costs. And while these factors can help struggling and stable farmers transition to more profitable operations, all three farmer segments face common challenges. The top three is the cost of farm input, low sales prices, climate change, and natural disasters. To address these, we see three key solution areas: financial inclusion, better access to technology, and enhanced education. First is financial access. If we want farmers to succeed, we need to ensure that they have access to the capital that they need. Loans are crucial, and so is insurance to protect them from the risks that come with unpredictable weather and market conditions. Second, technology. Sometimes the simplest tools can make a huge difference. Something as basic as better weather forecasting or data-driven insights on optimal farming techniques can transform how farmers operate. And of course, the dream is direct market access, allowing farmers to sell their products without middlemen eating into their profits. Third, education. We need to give farmers the knowledge to make informed decisions. Training on disease control, farm equipment usage, and even climate resilient seeds, can help them adapt, improve yields, and build sustainable businesses. We find lots of opportunities in agri-tech, and ultimately these efforts will be essential in matching agricultural supply with the country's growing demand for food. Before I end, and I've only got one page left, I promise, I just wanted to give a few notes about AI since that's what Alex actually asked me to speak about. As you all know, we like to invest in Filipino solutions to Filipino problems. That's just our core mandate for Foxmont. But what's great about the solutions that we invest in is that not only do they work hard to service our population at the base needs, they use every tool they have to increase efficiencies within their own operations. I believe that the great AI applications in the Philippines will be found within all the great startups as tools used for operational efficiency first and foremost, Sprout Solutions, by the way. However, I believe that AI usage and dependency will eventually turn many of these companies naturally into innovative AI-driven companies. I'll ask you to imagine some scenarios here based on my own portfolio. Imagine a company like Zenya, which I referenced earlier, which today is known for both its at-home wellness services, i.e. massages, and at-home medical services. It's really a hospital in your home if you use the entire suite of services. And now David Foote, who I consider a leader in AI in the Philippines today, is using AI for a variety of use cases. By using in-house agentic AI framework to do things such as AI-driven evaluation of doctor consultations, offering feedback for improvement, converting PDF lab results into structured digital formats, and analyzing uploaded medical records for doctor annotations. He also uses AI agents, monitoring finance emails to automate bill payments and accounting updates, assess provider and driver performance to determine necessary corrective actions, and oversee supply chain operations to trigger automatic restocking of essential products. And AI transcribing and evaluating provider-customer conversations, ensuring service quality and escalating or resolving issues autonomously. That's literally what's happening when you order a Zenya service to your home. But imagine a future where there is AI adoption for the entire medical field, thus freeing up the world's doctors on focusing on more pressing issues like urgent surgeries, or AI to be able to use its analysis of medical records to accurately assess what ails us. This is a future that's possible within the medical field and specifically within Zenya, a company that started as a wellness app that becomes an AI medical app, a reality made possible by using simple operational applications of AI first. Or a company like Italy, which I don't know if you're all familiar, but it's a e-commerce enabler that we invested in along with Kaya founders. It ostensibly helps offline companies sell online. Imagine that their AI is born within the company, taking insights from product reviews and ensuring that the consumer can get better products. Imagine using that later on to create AI-driven service that understands consumer sentiment immediately, what the consumer wants and needs, and instantaneously turns around and produces the product. No more stress testing products, all immediately available. And it all started as a tool for operational efficiency within Italy. And finally, Sourcey is another one of our portfolio companies. It's now an AI-driven company that knows all the greatest products in the world that can be bought at real-time market rates, full transparency, and super easy to get from all parts of the world into your home market. Maybe a little bit more relevant these days based on last Friday's news. To summarize all three cases, the main point of AI currently is to lower overhead costs. But with Zenya, it's also to lower human error rates, which is very important in healthcare. With Italy, it enhances customer experience, and with Sourcey, it helps to find new creative products for clients to use that they would have never otherwise thought about. In short, AI in the Philippines will not just come from new companies focused solely on an AI solution. It will come from the startups that already exist. That is born out of necessity and have immediate use cases. It's actually a very exciting time to see it all come together. So that's our own perspective on AI. Across all sectors, one thing is clear. The right support, resources, and innovations can unlock incredible potential. Whether it's in health tech, power, agritech, or AI, the Philippines is really, really at a turning point. And the opportunities for entrepreneurs and investors alike have really never been greater. But building a thriving building a thriving startup ecosystem takes all of us. It takes founders pushing boundaries, investors backing bold ideas, and a community that supports and amplifies the work being done. So I did want to take a quick moment to note that Foxmont is doing our own part in contributing to this. We are, of course, very imminently, you'll hear about our next fund. We're hoping that we know we'll be able to invest in a wider variety of startups now. And hopefully that includes everybody out there today. You'll be hearing more about that in the coming days. We look forward to seeing the continued growth and momentum in this space. And we encourage all of you to help spread the word. So please scan the QR code, do your own study, have ChatGPT run it and summarize for you, and help us out and spread the word. Thanks very much.